US consumer credit data came in at a much larger than expected $16.5 billion versus the $14.1 billion forecast, highlighting a growth of more than 6%. Here with the details is TD Securities' Gennadiy Goldberg. Rising debt levels are a sign that lenders feel comfortable issuing loans. But Gennadiy, which categories particularly are prompting this advance?
I think the markets took it quite well, but what you see is underlying growth is coming in the non-revolving category. And we've seen previously that has implied growth in student loans. So what you got was actually revolving debt, so credit card debt, actually fell during the month. That's not a very good signal in general. That suggests that consumer credit from a month-to-month basis is really shrinking a little bit, and the growth is coming in non-revolving debt.
With significant development from last month's reading of $13.8 billion, in addition to a forecast rebound in the labour market, are there signs of correlation between this data? Do consumers have reason to feel more confident in their financial position?
I think so in general. So what the trend has been over the last several years has been a steady improvement in the data itself. 1 month is obviously very little data to look at, but what you have seen over the last couple of years is steady improvement here. So as the labor markets have recovered, consumers have felt more comfortable. What we have, though, is a bit of an issue with student loans, where consumers are leveraging up, but with the labor markets recovering very slowly, there is some concern that there will be a crisis further down the road, or perhaps at least an issue where there's too much student loan debt and not enough jobs, so that the students who took out the loans wouldn't be able to pay them back, and that would weigh on other parts of the economy. I think that's a little premature at this point, but that's certainly something we're watching.
With banks loosening the reins on credit, are there concerns of a relaxation of standards by lenders?
I don't think so. There is some relaxation by lenders, but all my conversations with at least the bank side have suggested that loan standards in general have been very tight since the recession, and they haven't really loosened up to anywhere near pre-recession standards. So I think that loan standards are still quite a bit tight, so there's not really a concern that we're going back to a free reign of credit a la before 2008.
With mixed reports of a forecast weakening in the US dollar bull market, how does this translate into purchasing power for the US consumer?
Well, it really doesn't say much. The fall in the revolving credit does suggest that there may be some weakening in the purchasing power. Again, though, that is 1 month of data, and we have had very strong increases in previous months, so it's not necessarily indicative of a weakening U.S. consumer in general. We could see is a very strong rebound in the coming months. We have had labor markets recovered, as you said, and that could support the dollar bull market going forward.
Thanks, Gennadiy. Always great to receive your views. Still to come on Dukascopy TV, Ben Jones will be discussing the Bank of Japan's rate decision meeting today, so don't go away. Goodbye.